If history and returns are anything to go by, the decade gone by cannot be called as a lost decade for equity investors. Major equity markets have given strong returns, even though weakness and risk to global economy and loose monetary policy by central bankers was the highlight for the decade gone by. I guess somewhere the patience and stock picking has been rewarded once again. But in markets, money is not made by betting on yesterday's trend. You have to analyze the tomorrow. No point in doing rear view driving. You should focus ahead and try and understand the risk and the potential of returns. So to understand what lies ahead in the decade and what are the risks and what should be the expected returns with me, I have with me a special guest, someone who is now officially the CIO of India's largest AMC. Navneet Munot, CIO of SBI AMC joins us. Navneet, thank you for joining us. It's been a brilliant decade for you. Congratulations. 10 years ago, SBI AMC, less than $10 billion today, almost 1 lakh crore.
Yeah, so it was 5 billion or so. And yeah, today if we add our PMS assets that we manage for our pension funds, etc., it's more than $100 billion. Yes. So it's a phenomenal journey for us.
So we'll talk about it. But right now, let's talk about the returns. A point which I want to bring out for our viewers, that last 10 years have been called as the lost decade. Global growth was anemic. Central bank policy action was robust. The headlines which came out both locally and globally were about pain rather than gain. But the absolute return what equity markets have given in last 10 years has been breathtaking. And that data point will just come up on your screen. Nasdaq is up 3x. Indian markets are also up nearly 1.3 times, and Sensex has given a return of almost 1.3 times. Why do you think markets have given such strong returns when 10 years ago we were recovering from global financial crisis and generally global growth minus America has been a concern?
So globally, the cheap money has helped, facilitated by the central banks. Central banks globally have pursued an extraordinarily accommodative policy, running negative interest rates at several parts of the world. The total balance sheet of US Fed, ECB, Bank of Japan, if you add one or two more, Bank of England and maybe a Swiss National Bank, was like $3.5 trillion. That's today more than $15 trillion. So a lot of private debt has become a public debt because it's residing in the central bank's balance sheet. The money becoming cheaper when you're discounting your cash flows at a zero rate or a much lower rate, and then you of course put the equity risk premium, the valuations in the equity market can go up, which has happened in some of the other markets. Particularly in case of US, another interesting trend is the rise of some of these great companies in the digital space. So your Facebook, Amazon, Alphabet, Google, the Microsoft, and some of these companies have done extraordinarily well over the last several years. And in US particularly, and that's why the strong returns, the return of capital by these companies to the shareholders, there have been buybacks plus dividend payout in last 10 years would have been more than $5 trillion, which is like more than 20-25% of the market cap.
So let's talk about interest rates, something which I think is going to be the biggest jigsaw of part of this jigsaw puzzle. Interest rates have come down less in India but more globally, and I guess the decline has been nothing short of a precipitous. Interest rates cannot go down more than this. Look at the 10-year paper in 1999, it was at 6.4. We are starting the decade at 1.92, right? That's like world's most traded instrument has taken a knock of more than 4%, 400 bips. If interest rates in this decade do not continue the rate of decline what they've done in the decade gone by, what happens to equity returns?
So I think globally investors have to moderate their return expectations going forward. You will have very limited amount of re-rating of market. Returns have to be driven by the normalized earnings growth. Also, you have to keep one thing in mind about the US markets, that their profit margins are also close to at an all-time high. So you have a re-rating of the market and also also profit margins, which are already at an all-time high. Whether that can sustain is something that we need to watch out for. You cannot get further support from the monetary policy, that's for sure. My view is that from here on, fiscal policy is likely to play a bigger role. We have discussed that sometime before also. I think maybe Germany will start. It will be done by several other developed markets where fiscal policy will come and play a bigger role in building new sustainable infrastructure. Looking at the climate change, looking at the condition of infrastructure in developed world, you travel to US, look at the conditions of airport or roads or their utilities, etc. I think there is huge amount of investment that can happen. And how this will be funded? Pension funds today are investing in richly valued equities and extremely richly valued bonds today. For them, if you can provide them a 20, 30, 40-year good quality infrastructure asset and deliver a high single-digit return, they will be very, very happy. And China, because of their high investment in last several years, because of the high investment in China in last several years, there's a lot of capacity that has got created in terms of building the infrastructure that can be utilized by several of these countries. So my view is that capex cycle may come back over the next 10 years in the world, which will be a good quality growth even for the equity market, not driven so much by cheap money, but by actually delivering growth which create jobs, which in turns improve productivity and then create a more sustainable growth.
You have a large size and scale now, $100 billion. Managing that kind of an scale and generating alpha, could that be the biggest challenge? Because in India, what's happening is that after this economic crisis, only few companies are growing. And those companies which are growing, either they are trading at disproportionate premium or they are disproportionately owned by investors like yours.
So when you are moving towards a $5 trillion economy, is $100 billion with one asset manager too big? Not sure about that. I think there is a long, long way to go for our industry. We are still very small in India. Market capitalization will keep growing. Number of new businesses that will come for listing, that will also keep increasing, which is a different trend globally. So a number of stocks in NYSE have come down in last 10 and 20 years, but I think in India, the large number of businesses which are yet to come to the public market. So I think the overall universe is unlikely to shrink. In last couple of years, you are right that the overall investable universe, the quality companies that have done well, have not been many. But I'm sure that period is likely to change when growth becomes more broad-based, growth becomes more dispersed, and then there are opportunities in several other sectors.
The overarching theme which SBI AMC in a sense was able to ride on was consumption. You bought into retail banks, you bought into retail dominated franchises, you bought into pure consumption and FMCG names. And India went on a binge. Interest rates were low, crude prices were low, asset prices, real estate and gold was also low, which means consumer was able to consume much more. Aspirations increased because internet and connectivity also increased. Some of the factors may not be at play in the next decade. So what happens to the bedrock of your core AMC thought? Bet on consumer.
So the thought wasn't that consumption would do well, and that's why we bought these stocks. The thought was there are three ways of generating alpha in an equity fund. You do market timing, you do sector allocation, or you do bottom-up stock selection. Our focus has been on bottom-up stock selection. The sector calls are also largely a derivative of what you like on a bottom-up basis, and then from a risk overlay perspective, you need to have certain controls on that. We don't focus much on market timing. We don't think that that's our job, that's the job of the advisor. Now, bottom-up stock selection, maybe some of these stocks turned out to be in the consumption space or maybe in retail lending, but they were more driven by a philosophy that you buy a right business run by the right management and buy at a right valuation. And for that, you look at the competitive advantage, you look at return ratios, you look at capital allocation, quality of management, and of course the valuation. And I think that has been rewarded well by the market. And also, I think a lot of this alpha got generated because you try to avoid a lot of mistakes. I think the error of omission is okay, but error of commission is something that hurts you more badly. So I think trying to avoid lots of mishaps in last several years has also helped us, apart from identifying several of these companies at an early stage and staying with them through the cycle.
You know, they say that mean reversion is the biggest truism in capitalism. And market investors like yours who've seen decades and decades of market cycles, they would admit to it. Where do you think in this market mean revision is due, where stocks prices could enter into price-wise or time-wise correction, or perhaps both?
So we have seen that in 90s. In 90s, like towards the 99 and 2000, the valuations which were there for, let's say, an IT sector or in the consumer companies, several of them are again trading at a, particularly in the consumption space, are trading at a higher valuation, and you saw a mean reversion in the PE ratio, in the valuation over the next several years. Now we keep having this debate internally in our office every day that several of the high quality businesses where you have a growth predictability or higher certainty of growth, great management, very good governance, and then those stocks are trading at a very, very richly valued premium. But we have seen that markets several times underestimate the longevity of growth and the ability of these management to keep reinventing themselves and identifying new markets, new territories, new products, new ways of doing business, new ways of expanding their moat. And I think that gets underestimated by several people. I think some of those managements, even if the valuations are slightly higher, you would like to remain invested. Having said that, I think there are a lot of other businesses which today are not in favor simply because the economic growth is at 4.5%. In last several years, you are at the lowest end of, at the trough of the investment cycle. You are at a cyclical slowdown. We have seen a huge challenges in the corporate lending. We have seen sector level challenges, for example, in telecom. Several of them are on the cusp of a revival. And I think over the next 3-5 years, the rally is going to be more broad-based than what we have seen in last few years.
2016 to 18 or 2015 to 18 was dominated by small cap stocks. But now it's large cap stocks or mega cap stocks, which is where all the concentration is. Now my logic to that is, and my follow-up question before you answer is that every time when there is a displacement in the economy, the big players, they become bigger. That's where the market share and the domination moves. So if we are going through an economic displacement and an economic slowdown, the big players will become even bigger. So then why should one focus on small and mid-cap stocks?
So first of all, I don't think an investment philosophy depends on the market capitalization of the company, that there is large cap, mid and small cap. You look at a company from the same prism as I mentioned earlier. You look for a good business, good management and a reasonable valuation. That doesn't change. What happens in case of mid and small caps is that the universe is very large. Your opportunity of bottom fishing is much larger because you have top 100 companies that are large cap, next 150 in mid cap, everything else is small cap. So when you say that if the large cap companies are doing well, so let's say, I'm just giving an example, Bajaj Finance has been doing well for last few years. 10 years back it would have been a small cap, which became a mid cap, which became a large cap, and today it's a mega cap stock. And I don't see any reason that for next several years, in fact some of the stocks that have done so well for us were small cap, they have become large cap today and in last 10 years. I don't see any reason that next 10 years are going to be any different. I think you have to look at a business regardless of whether it's a large cap today or whether it's a mid cap or a small cap today. It's just that the share universe is very large, and maybe out of those couple of hundred stocks, if you have to identify 5 of those businesses, then the universe is very large. I also mentioned one thing. I think over the last several years, markets have always been paying a premium for the right reason to size and stability. To me, the disruptions that are underway, both locally as well as globally, it's equally important that you look at the nimbleness and agility of a management. And I think if a large cap company, if a large company has also got that nimbleness and agility, this will continue to do well. But history is littered with several examples where with size comes complacency, with success comes a lot of complacency. And I think you have to look at the management, whether they are complacent, whether they are paranoid, or are they paranoid enough to keep reinventing themselves.
Okay. Let's talk about the business growth for your AMC. $5 billion becoming $100 billion. That is an example in itself. But large part of your growth has also come because you're managing money for pension schemes. You're also managing index funds now. In last 10 years, because the world has got connected and interest rates have come down, passive investing has made a comeback. In the US, there is evidence which shows that best of the funds are struggling to meet their benchmarks. In next 10 years, could that happen in India?
So as you said that it's similar to what I talked about various managements, how you reinvent yourself. So we have invested heavily in ETFs, much ahead of the time. We are investing heavily in quant funds. We are investing heavily in ESG. We are investing heavily in our macro research. We are investing heavily in alternative data, all of those, because all of those are important if you have aspiration to become a large size asset manager. In terms of generating alpha, I think globally what we have seen in last 10 years that active managers have been struggling. Large amount of money has been shifting to the passive fund managers because index itself has delivered so well that all the other active managers have not been doing well. Value has been underperforming, momentum has been doing very well, and that's why I think we have been moving from a pure fundamental fund house to a more quantamental fund house. So fundamental research overlaid with quantitative research and try to identify several of these trends simultaneously. Whether we can continue to generate this alpha, I think alpha comes from you have an information edge, you have an analytical edge, and you have a behavioral edge. And in team, how do you create that? I talked about alternative data for the
market timing.
The information edge. You do various tools and processes and different kinds of ways of analyzing that data. For example, looking at what has happened in last 1 or 2 years. The importance of forensic accounting is so important today when you're looking at an annual report. The way you analyze things from a macro perspective, from a bottom-up perspective, looking at the global trends, that's important. And the behavioral edge. Market will always make some mistakes. If you try to avoid those mistakes as a fund manager or as a team, I think that will create a differentiation. I think if you keep investing to create an information edge, analytical edge, and a behavioral edge, I think people will be able to generate alpha. The only challenge for investor is how do you know today which fund will generate the alpha, because the pool of alpha is going to shrink. Institutionalization of markets and democratization of information, these two trends have led to shrinkage of alpha at an aggregate level. There would be managers who will generate, there will be managers who will not, because who are not generating, against them we are generating alpha. So you have to constantly reinvent, you have to constantly invest them. I'm sure there would be several funds who will deliver that alpha, but if you are not able to identify that manager, better to stay with an ETF. That's where also we are investing quite a bit.
So how does one choose them? Because if I look at SBI AMC, you have a consumption opportunity fund, you have an ETF fund, you have an ESG fund, you have a small cap fund, you have a focus fund. Someone has limited appetite. 15, 20,000, 25,000 is what the normal ticket size of an SIP in India is. You may look back after 10 years and say, look, my schemes have managed to beat the index. But what if the schemes I've chosen, they don't beat the index? How does one choose?
So of course, some of these have been outliers, but I think the experience would have been pretty decent even in some of the other funds. For that investor, I would say, let's say something like a multi-cap fund, which is managed by our analyst team. We don't take market timing call, we don't take large sector bets there, and it's a completely bottom-up portfolio of 40, 50 stocks chosen by our analyst team. And you play across large cap, multi-cap, mid-cap, mid-cap, small caps, and trying to identify businesses from a bottom-up perspective. Something like that is good. They don't have to take a sector call or a thematic call or something.
If you have to identify 2 or 3 trends which will continue and 2 or 3 trends which are small but they can become big. I mean, if I look at a classic equity fund, the blue chip scheme, you will buy clear winners there. If I look at the small cap schemes, you would buy future winners there. Give me an idea of your thought process. Clear winners and future winners.
The runway of growth in India is so large over the next several years also, because economy hasn't done well in last 1 or 2 years, and the overall number of companies that have done well have shrunk. It doesn't mean that this trend is likely to continue. The trend can change. Growth can become more broad-based. I mean, a year back or 2 years back, there were hardly any insurance companies or asset management companies that were in the listed space. Even in a sector like NBFC or HFC, which are struggling, some of the biggest wealth creators have been in that space. I'm just giving these examples to showcase that
insurance has got
the growth potential is so large in India across all sectors. So we talked about the consumption and the higher valuation of several companies in that space. But there are so many niche areas where the total size of opportunity is so large relative to what it is today. As India grows from $2.5, $3 trillion to $5 trillion, and if we are able to pull out millions of people out of poverty to a consuming middle class, and several of the middle class to an upper middle class, where their ability to consume various products, which is not there today, starts emerging, then you are going to create several categories. Who would have thought 10 years back that an innerwear company will have a market cap of couple of $1 billion?
What about the reverse? So if you bought IT or TMT, let's say 1995 to 2000, you hit a home run. They were the best compounders, and in 2000, before the bubble actually busted, it had just appeared that that trend will continue for another decade. What has worked in this decade, and what do you think the current trend will not replicate itself, whether it's because of earnings or purely because of the disruption?
There have always been disruptions. Early 90s, you go and check what was there in Sensex or top 100 companies. Several of them don't exist. And you look at 2007, we were just chatting about several companies which were in Nifty, top 50 companies in India. Several of them are in NCLT today. And that kind of creative destruction, as Joseph Schumpeter talked about, continues forever. And that's why I said, when you have a market like India, where you have large opportunity consumption, I think there is huge runway ahead for investments. And India has a lot of opportunities, even on the export side or the outsourcing, though we have not done well at an aggregate level over the last 10 years. But given the talented pool of people that we have, educated pool of people, I think there are a lot of opportunities even on that side. Now, we put all of these three together. The focus must be on identifying the right people, right management who can build those businesses. And there are so many of these digital disruptions, technological disruptions, disruptions created by ease of doing business, disruptions in logistics, disruption in a lot of factor markets. I think there are going to be new set of winners, and you try to identify that winner rather than taking a large sector bet.
So a couple of closing questions. I'm going to take the Nifty a decade back. Financials were about 26-27% of the weightage. Now they account for 40% approximately. I'm not including insurance here because insurance is not part of the Nifty.
It is yet to come.
Exactly. 10 years from now, what could be the face of Nifty?
So several businesses are not there. This is the interesting debate we have in our office every single day, including yesterday, about financials. That you are yet to see several of these insurance companies, asset managers to come into the top 50 or so. The weight is already reaching 40. Can it be 50, 60, 70? Because you look at S&P 500, it's 13-14%. US is like a financialized economy because the technology companies have got much larger share today. I mean, 15, 20 years back, there was a period where oil and gas was a very large part of Nifty. Before that, in 90s, you talked about the TMT and the consumer companies. Whether it will be 10 years later different, I think it will be different, and it's always difficult to predict that. But I can visualize that would there be not many companies from services sector, which is so large in India, would there not be a healthcare company? I'm not talking about a pharma company in Nifty. I think there could be. Would there not be few companies from real estate, which is such a large sector, which is likely to get organized? There could be. Would there not be many other companies from the digital space? The kind of data revolution which is underway and the way of doing business is changing. Some of the financials that are there in the Nifty today are also basically because of their investment in digital technology. What will not be part of Nifty?
Because Nifty is only 50, right? So somebody has to get out before somebody to get in. First, you take the company out for another one to enter. Which sector?
So even in, that's a great question. So even in financials, I won't take names, you know it.
Of course.
There are the ones in the same space moving out of the Nifty, and there are the new ones who are getting into the Nifty. So even if the sector is same, I think it's also a lot depends on the individual, those companies. But there could be few things which may not be part of Nifty a few years later.
What is your aspiration? Now you cannot grow at the rate at which you've grown in the last decade. 5
Why
billion. So we are looking at 5 billion.
I keep thinking, if our IT industry could serve large global Fortune 500 companies, why our asset management industry cannot do that? I think if there is a support from the policy makers, and I think all of us keep investing, and with the help from people like you, why should we not have that aspiration? Investing is same everywhere in the world.
So the big picture for the AMC business is looking strong.
I think so. But you have to keep in mind of lots of disruptions, just like in any other business, in our business also. Margins would be under pressure. You had a bond ETF at the fee that you are aware.
Fidelity is asking no charge.
We are running our ETFs at 7 basis point or even lower. I think so there is going to be pressure on margins. So you have to reinvent your business continuously. You have to continuously find ways to deliver alpha. If you don't do that, people are not going to pay you fees. It's very clear. Writing is on the wall.
Just one last question, and something which is, these are not my words, these are words from billionaire investors like Ray Dalio and Howard Marks, and all they're saying is that, look, it's too good to be true. There is no cynicism and there is no skepticism in the world. And typically when that happens, bad news comes after that. Is there a risk of a global shock? We don't know today, but if that happens, will this entire fairy tale collapse?
So known unknowns, everybody knows. There's a risk from trade war, there's a risk from polarization in the world, there's a risk from deglobalization, there is a risk from cyber security. All of them are known, but you don't know where the unknown comes from. And that's why, in fact, in my annual article, I've written about capitalism with conscience. If capitalism has to do well, we have to bring the sense of purpose very deep into business, and also investors like us, that we need to have that strong sense of purpose embedded into our business model if we want capitalism to thrive and create more prosperity for a large number of people. That to me is a big risk. If we don't address climate change, if we don't address inequality, if we don't address this pompous populism, there could be some other risks which are difficult to visualize today. Look at Hong Kong, look at what's happening in Extinction Rebellion, the Yellow Vest movement in Paris, look at several of these protests across the world. They are saying something. And I think we have to ensure that for capitalism and liberal democracies to thrive, we address that. And that's where I think the role of investors is underestimated several times. We think, what can we do about it? But we invest in businesses, and if we drive businesses towards the right cause and right purpose, and I think we can make a huge impact on society.
So ESG is a theme to watch out for next
year. It's a big thing for us.
How does one invest in ESG?
Sorry?
How can one invest in ESG?
So one is, of course, we have a focused fund, and on PMS, we have, for the last several years, we've been running a fund which is very socially responsible. But even as a house, all investors, we all worry about how much alpha will generate, the discussion we had. What about the beta? If market has to deliver 15%, if corporate profits have to grow at 15%, you have to do the right things that society will allow you to make that profits. We have seen what happened with the mining companies, we have seen what happened with infra companies, we have seen with several of the other sectors without taking name. If we don't do the right things, if investors don't drive the corporate behavior in the right direction, then there is a risk to that market return itself or the economic return itself. So to work with the policymakers, the business community and media and all stakeholders have to work together. How do we increase the beta of the market? Of course, alpha is the second thing.
Of course. Well, I appreciate your time. Good luck not only for the year, but for the decade, and thank you for joining us.
Thank you. Pleasure.